Sanjeev Prasad, Senior Executive Director and Co-Head of Kotak Institutional Equities, joins us live. Sanjeev, fantastic to have you back. Thank you for joining us. Sanjeev, large part of the pain in the system is global in nature and was largely injected because of fears of tight liquidity. Do you think globally some clarity has emerged and global fear has subsided?
Not really, I would think. I think looking at the FOMC minutes which came out last night, it is clear that, at some point in time, the US Fed is going for a tapering down of the bond buyback program. And maybe it will happen in December, early part of next year. That's, pure speculation. But given the fact that there is some improvement in the US economy, job data is coming out to be reasonably good. I assume at some point in time you will start seeing a tapering down. It's not going to be, complete shut off of the tap on one fine day. But I think the world should be prepared for environment where the global liquidity is less benign, and I think India is probably going to be a lot more vulnerable in that kind of situation. Both emerging markets and India in turn, and especially countries like India, which are running a fair amount of high current account deficit. Those countries should be prepared for some amount of pain at a time when global liquidity is going to be a lot less benign.
What's the expectation then from Infi tomorrow?
Well, we are not looking at any great set of numbers for Infosys. As far as the quarter-on-quarter revenue growth is concerned, we are looking at 0.8% in dollar terms, which is, I guess, on the lower side of the implied CQGR range. As far as the EBITDA margin is concerned, there will be some decline over there, primarily because cost would be on the higher side based on, visa cost being higher. That's typically there in the first quarter. Some increase in wage cost and sales and market related expenses would also be on the higher side. So there would be a decline in EBITDA margin somewhere about 100-150 basis points. I think the more important thing over here would be, the kind of guidance which the management gives, whether it sticks to the 6 to 10% dollar revenue growth guidance which I had given at the beginning of the year for the full year, that is, and whether it sticks to that. I assume the market would be in a slightly generous mood for Infosys because this is effectively the first few days of Mr. Murthy coming on board, and it would be too much to expect a miracle. So I think people wait for 2 or 3 quarters before taking a call as to whether the change in management is really working out to the benefit of Infosys in terms of stabilizing the ship and fixing whatever were the issues earlier.
Sanjeev, if 6 to 10, what Infosys earlier had indicated in terms of a revenue growth, gets slashed to 5 to 9, are markets likely to punish that stock, or will markets give benefit of doubt to that stock?
5 to 9 is okay. I think if it is more like 3 to 6 kind of a number, that's when people will start getting really worried. 5 to 9 with a fair amount of support from the rupee, I think people will live with that, because remember we have a pretty big state built for all the dollar denominated revenues like IT companies. At least in the next 1 year horizon, looks like that's going to be the case.
Sanjeev, what else are you expecting from this time's earnings season? I mean, can there be a lot of dark horses or sort of surprise winners that we can expect, or do you think this quarter again is going to be lackluster to weak?
Well, it's not going to be a great quarter, that's for sure. We are looking at a 4% decline in the net profits for the BSE 30 index, pulled down by 2 sectors. One is energy sector, where ONGC is not going to have a great set of numbers, primarily because crude prices have come down, and even though the subsidy amount in rupee terms is lower, the government of India is insisting on charging the upstream companies $56 a barrel, or in the case of ONGC, it's more like 63, including the condensate. So the realization will drop by about $7 a barrel for ONGC, and that will reflect in a 33% decline in the net profits. The other sector which will have pretty bad numbers is the metals and mining space, where on both Q&Q and YOY basis, the LME prices are lower. Plus, there have been some shutdown issues in certain companies. There will be forex loss in the case of JSW Steel. So in general, you will have bad set of numbers for the metals mining companies. Other than that, I don't think, you should be expecting too much in a situation where, the volume numbers in general have been bad. Auto numbers already out for the first 3 months. So what numbers to expect over there. Cement volumes have been pretty weak. So positive surprise, I assume, is going to be limited. The sector we should watch out for on the downside is, I guess, the banking space in terms of what further bad news are there on the NPL side in terms of both restructuring, slippages, and provisioning. So we'll have to wait and see what happens over there.
Sanjeev, at a time when it is difficult to find a positive catalyst, rupee is down, earnings are yet to bottom out, crude is again sitting at a fresh 15-month high, globally there is a big question mark when it comes to liquidity, markets are still holding on. Do you think we should respect the trend? Do you think we should acknowledge the fact that markets are resilient and we may have a bottom in place?
Well, if the market was so smart, then I don't think any of us should be in business in that case, I mean, you can go back in history and look how smart the market was, let's say, at the peak of December 2007, early part of January 2008, and the kind of stupid valuations being accorded to, all the infrastructure companies which did not really have much of a business model. So, that's a separate debate altogether. But I think there is still a lot of cause for concern. I don't think we have seen the, I would say, the resolution of the current account / BOP issues, because structurally we do run a pretty large current account deficit, anywhere between $6 to $8 billion on a monthly basis, depending on what crude price, gold imports you assume, and we have to make sure we get that kind of capital flows into the country. And remember, this is at a time when the global environment is not that benign. Last 3 you had a lot of global liquidity, money was going to emerging markets, India got its fair share. And we look at last year, for example, that is fiscal 2013, you had a huge current account deficit which was much higher than what we're expecting in the current year, somewhere about $85 billion, but we got that amount of capital flows. I'm not very sure the market is going to be that generous this year on both the equity side and also on the debt side. The debt side of the equation worries me a lot more than on the equity side. Equity side, at least we can do a few things, but on the debt side, you look at the interest rate differential between, let's say, a 10-year G-Sec yield in India versus 10-year G-Sec yield in the US. It's down to less than 5%. So clearly that's not attractive enough for anybody to be investing in the debt markets, and at some point in time you could see maybe more money getting pulled out. So that's definitely a cause for concern. On the equity side also, unless and until some more sectors start emerging favorably, I am not very sure you will continue to see money coming into the same set of stocks, but how much more of Hindustan Lever, ITC, Sun Pharma type of names can the foreign investors continue to buy, given the fact that most of them are trading at pretty expensive valuations. Year to date, if you look at the combined portfolio flows in the country, that is actually minus $500 million as of now, which is not good, and clearly will require capital flows to come in to balance the current account deficit. Otherwise, there would be issues in it, let's say towards the end of the year, early part of next year, whenever you see some tapering down of the US Fed program, coupled with, I would assume, some amount of political uncertainty in India as we head into the elections.
So, what is your call at the current juncture? Sell out of equities, don't buy into equities. At the current juncture, the risk-reward ratio is not favorable?
Well, it's not favorable certainly for the more expensive names. Maybe they don't come off, but they could probably remain here for some time. I don't think I would be looking at buying any of the consumer type companies at the kind of valuation they are trading at. Although at least, fundamentally they are very strong companies, good cash flows, etc. But, just valuations don't make much of a sense at this current juncture. Or I would be interested in buying, the industrial infrastructure type of companies with very weak balance sheets, etc. So one can build some sort of a middle of the road portfolio. There are enough number of stocks which are trading at reasonable valuations, regulated utilities, telecom, even bits of pharma is okay, some parts of automobiles are fine. So you can still, make a portfolio and, stay there and, wait and see how India, manages the next 6 to 12 months in terms of, one is how we tackle the BOP situation, and the second is how we tackle, probably deterioration in the banking system, given that inflows are probably going to be much bigger than what people are anticipating.
Okay, Sanjeev, good to have you on the show. Really appreciate you taking the time out and joining us.